If you dispose of any crypto assets that you hold, then there is likely to be a capital gains implication if you are here in the UK, USA, Canada, Australia, in fact, almost everywhere in the world. But what exactly is a capital gains tax for crypto assets? This is what I'll help you understand simply and in under 5 minutes. So in the vast majority of cases, if you're a crypto investor, trader, or even a sophisticated trader, you will pay capital gains tax on any profits. That is gains in capital gains tax language when you dispose of your crypto. So what exactly is a disposal, also known as a taxable disposal? Simply put, if you carry out one of these 4 acts with your crypto, then you could be liable to a taxable disposal. Number 1 is selling your crypto for fiat currency. That is US dollars, GBP, Aussie dollars. I think you get the picture. Number 2 is exchanging one crypto for another. That is non-identical crypto like Bitcoin for Ethereum. 3 is buying goods and services directly with your crypto. Number 4 is gifting crypto. So what exactly is capital gains tax for crypto assets? Well, first thing is first, there's no such thing as a specific capital gains tax for crypto assets in itself. You see, most tax agencies around the world, that's including HMRC in the UK, the IRS in the USA, classify crypto assets as property, so they class it all together. And therefore, as the name suggests, capital gains tax is a tax on capital gains. Capital is wealth like crypto assets that is used to make more wealth, and a gain is an increase in the value of that wealth. And the opposite can actually occur. A loss is a decrease in the value of the wealth. See, capital gains tax has applied to assets such as stocks and shares, residential and commercial property investments, art, collectibles, just to name a few, for absolutely years. Remember, the following 3 things have to apply in order to trigger a disposal for capital gains tax purposes. Number 1, you need to be a taxable person. Number 2, you need to have disposed of a taxable asset. And number 3, you have to have made a taxable disposal. Now, if you're an individual investor or trader of crypto, then you, depending on where you are resident in the world for tax purposes, you are the taxable person. Crypto assets are taxable assets. And finally, I've already listed out the 4 most common taxable disposal or disposition events. So how exactly do you calculate capital gains tax on a taxable gain? In very basic terms, a chargeable asset is sold for more than the purchase price, then a capital gain arises. And remember, you are only liable to pay capital gains tax on any gains you make and not on the gross proceeds itself. So let's look at a quick example. So Roger bought 5 Ethereum on the 1st of January 2020 for $10,000, pricing each Ethereum at $2,000. The exchange he used charged him $200 in transaction fees that allowed his Ethereum to be included on the distributed ledger blockchain. His cost basis is therefore $10,200. You want to learn more about cost bases, the different methods, LIFO, FIFO, HIFO, average cost base methods, watch my course in the description box below. On the 7th of March, the market value of his Ethereum increased to $18,000. That is $3,600 per Ethereum. He's now sitting on a $7,800 realized gain. And no tax is actually due on this yet, as he has not triggered a disposal. On the 10th of March, Roger decides to sell all 5 Ethereum coins he holds at the market rate of $18,000. And this is exactly the fiat amount that he receives. And in return, he has now triggered a disposable event that is subject to capital gains tax. How much capital gains tax Roger actually pays depends upon where he is tax resident. If he were UK resident, then he would either pay 10% or 20% on the $7,800, or the GBP equivalent of it, depending on his total income in the tax year. And this is after a capital gains tax allowance of £12,300. If he were a US citizen or tax resident, then given this is a short-term capital gain, in other words, under 12 months, then according to the 2022 federal income tax rates, he would be subject to anywhere between 12% and 37% on this $7,800, dependent upon how much ordinary income he actually earned in the tax year. And yes, you can make taxable losses too, I know. How on earth does that work? Keep watching and I'll explain simply very shortly. So what exactly are the current CGT rates at the moment? Well, capital gains tax rates vary from country to country and from one financial year to another. Here in my home country, the UK, the key rates applicable to crypto assets are, if you are a basic rate income taxpayer, then 10% of capital gains tax applies. And if you are a higher or upper rate income taxpayer, then 20% capital gains tax applies on any crypto gains. And if you're a US citizen or tax resident, then capital gains tax rates are split into short term, that is 12 months or less, and long term, which is greater than 12 months. Short term rates are in line with ordinary income tax rates, starting from 10% all the way up to 37%, and long term rates are known as preferable rates. They start from 0% through to 15% up to a cap of 20%. And if you want to know the CGT rate in your country in 2022, then download this handy guide by clicking on the link in the description box below. Yes, I hear you ask the question, what if you're making losses in a bear market? And this can happen. As we know, in bear markets, you may be sitting on what's called unrealized losses. That is when the value of your crypto asset is actually less than its base cost. And if you dispose of your crypto and realize a loss, then unfortunately from an investor perspective, you have lost value. But from a tax perspective, you can use these losses to reduce your overall or future tax bills. Losses can either be used in the current year to offset against any gains, therefore reducing net gains, and or any unused losses can be carried forward to future years with no expiry date. And this is pretty much applicable in the UK, USA, Canada, Australia, and many other countries across the world. And if you're in the USA, you can actually even use up to $3,000 of capital losses and offset this against ordinary income in the current tax year. Now, that's a bit of a smart way to avoid taxes legally. But here's the thing about avoiding taxes. It can be quite a fine line sometimes in the crypto space between that and evading taxes, one being legal and the other one not. And whilst you all want to legally minimize your tax bills, you certainly don't want to be breaking the rules. Which is why this next video will 2x your understanding on the differences between tax avoidance and tax evasion, and potentially stop you from being audited or investigated by a home tax agency.